Hello there, it's Richard Bowser here from Property Investor News magazine. Tonight I'm in central London at the Institute of Directors with Mark Lawrinson from Portico. And this is an event with the National Landlords Association that we're here tonight with. So Mark, good evening.
Good evening.
Mark, you've did a presentation earlier, but first of all, can you just explain what this event is about?
Yeah, of course. This is our annual event that we do in association with the National Landlords Association, held here in the Institute of Directors, and it's our way of being able to, converse with landlords across London about what's going on in the London property market, in the rental market, across Greater London and maybe further afield, and also help keep them, abreast of legislation changes, policy changes, and more recently, tax changes that they have to deal with.
And you've got a sort of a network of branches pretty much spread over central London out and also north, south, east and west now, from what I saw earlier?
Yeah, we have. We've now got 17 offices, that cover 21 boroughs, across London. Primarily we were kind of north, south, west and central, and we've recently added, further 7 offices under the brand of Spencer's out in Essex and East London, which means we've got a coverage of every corner of Greater London and the data to go with it.
Yes, that's important. And you showed some of the data earlier, and just talk about that in a minute. So essentially you're seeing not just a sort of London-centric Zone 1 market, you're also seeing what I call normal London, and you're dealing with tenants and landlords in normal London. People dealing with people who are on normal wages, average wages, not just the sort of international money-led central London market, which obviously is a different world to many people. So you presented some data and you showed us some heat maps which effectively showed areas of red or pink from about 2 or 3 years ago, and we're focusing on the data that you showed on London and the individual boroughs. Mm-hmm. And clearly you then showed another set of charts 2 years on, which clearly showed that because of strong price growth, mm-hmm. many boroughs now yields are sort of in the 3 to 4% bracket, and some around 3. Is that right?
That's correct. And I think it's exactly as you say. With the strong price growth, that's gone on across London over the past kind of 3 years, that has an impact on the rental prices and the yields that landlords can actually achieve. And we saw even 3 years ago, you were able to get over a 6% yield in a handful of boroughs, around London, whereas, based on this year, 2016, you're not able to get that. As a borough-wide, that is, if you take the borough as a whole, you're not getting much above 3 to 4%, as you rightly said. But actually, as a result of, an interactive yield map that we've got at Portico, you can find kind of pockets, almost microclimates within the borough, where there is still that potential of getting greater yields. But if you look at the borough as a whole, then yes, the yields have suffered over 2016.
Well, we can't have it both ways as landlords. We'd love to have that, wouldn't we? We'd love to have both capital growth and also yield staying relatively high. But the reality is, if price growth occurs, then generally speaking, rents tend to track wages, and as you said, the impact of that in the last 2 or 3 years is London is that yields are probably at historical lows. How are you seeing your clients, your landlords, react to that in terms of what are they doing now?
I think for a lot of them, especially the established landlords, they're holding firm. They've been landlords for several years, and the properties that they've likely got at present are properties they've had for years. So as much as we're seeing the yields where they are now, they're based on the current prices to purchase now. So if you purchased several years ago, that's not to say that you're only getting a 3 to 4% yield now. If you're established and you've had that property in place, then you'll be okay. So for those landlords, we're seeing them, as I say, just hold firm because they're all right. In terms of people entering the market, again, the established landlords know how to enter the market properly. It's more the landlords that maybe would have picked up one property as a potential pension or something they were able to keep as they bought another property, and those kind of landlords aren't really entering the market because the yield isn't there for them.
So the sort of vanilla buy-to-let landlord is now very much being deterred by not only the yields but also some of the other factors that we've been talking about here tonight at the event, tax changes, etc., etc. So when people are buying now, are they being sort of more creative with their buying?
Yes, certainly. I mean, depending on what it is they're buying for, because as you've rightly said, I suppose in London, a lot of people tried to think they could have their cake and eat it, and they bought in London because they got capital growth, and they were also getting an over 6% yield. And sometimes you can't have it both ways. You've got to look at which it is you want, and now we're in a market where the prices are strong and they've been growing, so you can get that, but the yields aren't necessarily there. So people have to be creative with that, and especially with the introduction of greater stress testing from the banks, which is going to become mandatory in January, as we know. People are having to put more money in. So if they're doing that, then they're having to look at other avenues, development opportunities, commercial into residential, and the permitted development opportunities that they may have, and all of these elements are coming into, established investors' kind of mindset.
Yes, you're saying things that are certainly I'm seeing myself and experiencing myself with subscribers to Property Investor News, so it's good to see that reaffirmed. Mark, we talked about what people are doing, and we're focusing specifically on London in the context of this conversation, maybe the inner southeast. But clearly London has been a strong performer. Perhaps there's now more price growth occurring in some regions in the UK, some cities, but London historically has always done well, very well, over 10 or 15-year periods. Where do you think we are in the cycle, and do you think, taking a sort of 5 to 10-year view, people should still be looking to hold and to purchase selectively more property to rent in London?
Yeah, I think so. I think we saw, even from the last recession, even with the 10 to 15-year cycle that people talk about, we had the recession, the market dropped and prices came down by some 15%, but within 18 months London was already back on the up again, and London has shown as a city that it is forever resilient, which is why I think investing in London will never go away. And as much as there are great opportunities outside of London, as the cycle may change or even come to an end, as long as you're in a position where you can hold for a couple of years, I don't think you're ever going to be in a bad position.
Mark Lawrinson from Portico, thank you very much for those comments. It's Richard Bowser from Property Investor News here at the IOD at the NLA Portico event. Thank you.